It's great to be with everybody this afternoon, and I want to talk today about a couple of things about how these markets are moving and how this is a great opportunity. These are amazing times for many reasons. I'm going to get into it in just a second, but the first thing I always tell people is turn off the television. Pay attention. Thank you for your attendance today, but turn off the television is kind of a theme. I tend to do a lot of broadcasts because I'm here in Chicago. I'm at the Exchange, I'm at the CBOE, and I'm at the CME. But what I encourage people to do is not to watch the 8 hours of CNBC on a daily basis, or the Fox Business or the Bloomberg or whatever your choice is, because you got to understand that those folks are in the business of making money selling advertising, not helping you make money. So be aware of that. So today we're going to talk about a couple things. I got a couple things I want to share with you, but my first big promise here today, the one thing I want you to walk away with is a new attitude, an attitude adjustment, an appreciation for the opportunity that always exists in this market. It doesn't matter whether we're going up, down, or sideways, there's always opportunity. You want to be able to turn that frown upside down. You want to be able to turn lemons into lemonade. There's always great opportunities, and I'm going to get into that and why now is the best time in history for the individual investor. There are many things that have come together in the last 5 or 10 years. Like I said, I dabbled on the trading floor. Those guys used to have an advantage. They knew how to print money, and they still have some tricks up their sleeve, but the individual investor has leveled the playing field. Now with electronic access, you can trade any market, anytime, any direction. You can trade currency, stock, options, commodities, whatever's on the move. And you can trade foreign markets. So in this global economy, there's always these opportunities. When I was a younger trader in the pits, you were limited to whatever market you were in. So if I was in treasuries, I couldn't just walk over to the soybean market or over to the gold market and trade there. They had their territory. So it was a much different ballgame. You had to take advantage of the opportunities as they came. Now, if there's not something in the next half hour, there might be something by day's end. If not, there's something tomorrow, there's something next week. There's always these very, very big opportunities. And I tell the story of when I was a younger trader, my girlfriend, who became my wife, would often call me in the afternoons and find out that I wasn't at work. I'd be up at Wrigley Field watching baseball games. And I had to explain to her that I was actually saving money by not trying to force the trades in the pits when nothing was happening. So before you had to pick and choose, now you can pick and choose and only choose only the best of the best opportunities in the marketplace. So there's also low commissions. Commissions, Bear Stearns and Merrill Lynch used to be $100. Now, more importantly than the commissions now are $5 or $10 and such a small factor. No one likes to pay commissions, but at least it makes you think about your trade and having a discipline. There are also tight bid-ask spreads, meaning you can get in when you want and get out when you want. So that means that the risk control is significantly greater than it's ever been. You can execute your plan. You can plan your trade and trade your plan. So today, let's walk away with the idea here that there's always opportunity. Be optimistic of opportunity. Markets aren't good or bad, they just are. So a couple of things I'm going to share some secrets with you today. I'm going to teach you, I'm going to share the way that I approach the markets here and the way that I go after it with my 25 years plus experience. Hopefully I don't look like an old grizzled trader, but I am. I've been doing this for a long, long time. And it's all about discipline. It's about having the right approach and having the right mental frame as well. So I'm going to show you how I pick only 70% probability plays. Each and every trade I choose has at least a 70% chance of being successful. So it's about picking probability. I'm going to show you how to do that. Also, besides the attitude adjustment here, I'm going to show you how to use options instead of stock. Vince did a great job with that introduction to options. I'm going to show you how simple it is to attack the markets and use options as a vehicle. And most importantly, I think, I'm going to communicate how important it is to have the markets work for you. Have it fit your lifestyle. I know there are people that are active traders, well, you know, and I had done that, and I guess it's more glamorous in retrospect than it was at the time. But what I realized, I want the markets to work for me. I want to be able to not have to watch the markets tick up and down all day, every day. I want to be able to use options to take advantage of a longer time frame, still have that accessibility to that opportunity, and I'm going to show you how here in just a second. So I'm going to show you more what I view as lifestyle trades. They fit into your lifestyle, so you don't have to watch the markets every day. You can let the markets do the work. So let's talk about where we are and where we're going. A couple of simple things. Obviously, you can see this, the markets have been an upward movement over the last 6 years. We've been trading sideways within this range in the S&P. The S&P is the market. The Dow Jones is only 30 stocks, and it's weighted by capitalization, not by it's weighted by price, not by capitalization. So that's not a fair barometer of the market. The S&P is what your 401ks is scored against, what your mutual funds are scored against. If an investment advisor can't beat the S&P, he loses his job. So we've been an uptrend. You have to respect this uptrend, and every time the market sold off, it's bounced back. So if you go back to October 2014, if you go back to last August, and if you go back to February, the markets had these big 10% sell-offs, but then they bounced back. And just last week, we were at the top edge of that trading range. We've been in this trading range, this wide range here between, well, I guess, no, it's not that wide, but in this range anyways, between 2120 and 2040 in the S&P. And last week, when it couldn't blast through that and make new highs. Remember, we were only a few points away from all-time forever highs in the S&P just last week. Sentiment has changed. Psychology has changed for a lot of people. But this is a great opportunity. I'm going to show you a strategy to take advantage of it. And it's extremely satisfying to make money when people have this extra level of uncertainty and this extra level of fear. So I'm going to show you a quick little trick there. But we've been trading sideways. You've got to respect the overall upward trend in the markets. Every time the market's sold off, it's come back. So I'm not going to be the one guy that say that it's not going to come back. I'm not going to be the guy that's going to say it's going to go higher. I'm not going to be the guy that's going to try and pick the top in the market. There have been a lot of casualties and a lot of money lost for people trying to pick the top that didn't believe in the market the last 5 years. So I'm going to trust what the tape tells me. Another factor that I focus on besides price is volatility. And I use volatility to determine what strategies are appropriate under the market conditions. So if you look, the overall trend in stocks has been up, and the overall trend in volatility, or the fear, has been down over the last 7 years. And really, we've been trading sideways there as well, between 20 and 12 in the VIX for many years here now, going on, what, 4 or 5 years. So right now, we're at the upper end of the range. We just broke out above 20 with this recent bout of volatility, or VIX-explosion, as I like to call it. You know, we've had a big rally here just in the last few sessions. Like I said, the picture has changed for whatever reason. People have gotten so much more fearful just in the last week or so, but the fundamentals haven't changed. Nothing has changed. You know, the Brexit vote, we've been talking about that for the last month or so, and actually the market had moved up until last week ahead of that. So, you know, let's see how things filter out. It's just another case of, you know, it's the crisis du jour. If you think about over the last 5 years, it's been the Eurozone, it's been Greece, it's been China, it's been, you know, one issue after another that that some people thought would bring the global financial markets to a screeching halt, and that hasn't happened yet so far. But there are opportunities. So if you look now, the volatility's at the upper end of the range, but still not to these extremes that we saw in February or obviously last fall. But that volatility helps me determine what option strategies I'm going to use to attack the market. So I use options for a couple reasons. We'll get into that in a second. Like I said, I've been doing this for 25 years. I've got a plethora of experience in the marketplace, and I'm going to try and guide and share share that with you right now. Today's theme is how to take advantage of the market fear and profit right now. So let me show you how to do that. At the end of the presentation, I'll show you how people were completely right picking that February bottom, but still ended up losing money, and I'll show you how to avoid that. So what I want to talk about today are how to control two factors. I want to be able to control time, which is your greatest asset, and probability. So if you think of Warren Buffett and his success, it's because he has unlimited amount of money and unlimited amount of time. So he's going to be in a position till he's right. So what I want to do is extend my time window so I have enough time to be right. And I also want to, as I alluded to a few minutes ago, I want to make sure that my trades have put odds on my side. So I've got a 70% probability or greater of success. Buying or selling a stock, you got a 50-50 chance. I'll show you a way to choose your probability. Do you want to choose an 80% probability? Do you want to choose, you know, a 70% probability? You know, you get to choose your probability factors, and I'm going to talk about that as well. But trading is very simple, and it should be a pretty boring methodology. You're waiting for these situations to develop, and you're waiting for only the best of the best. You're looking for a reason not to do a trade as opposed to a reason to do a trade. And I use the words trade and invest interchangeably. Actually, I use the word trade more often, because a trader is someone who has a plan to make money. An investor just wants to make money. There's a big difference. A trader knows where they want to get in, where they want to get out, what they want to risk, and what they want to make. An investor wants to make money. So methodology for trading is very straightforward, very simple. You have to know your cost, your risk, therefore your risk reward, your probability, and where your break even is. Once you know those factors, you can objectively decide if it's worth moving forward. So I use options as my vehicle. For many reasons, options give you leverage, you have less risk, you've got less capital tied up, and you can control your probability. But a lot of people have some misconceptions about options, and hopefully if you listen to the last speaker, Vince, he dispelled a lot of those myths. But I'm going to go through that some people, some very smart people, are very intimidated by options when they really shouldn't be. Options are just a vehicle. Again, the markets can only do three things. They can go only up, down, or nowhere. You can put on option strategies to make money from where the market goes, from where the market doesn't go, to take advantage of time, to take advantage of volatility, to take advantage of other variables. But the whole idea is that options are not complicated. You can make it very straightforward, very simple. There's only a handful of strategies that you typically want to use. And with volatility still relatively low, lower than it was last year and the year before that and the year before that, the more complicated strategies aren't suitable right now because the volatility component is not there. But anyways, you want to use the right strategy for the right conditions. You want to be able to pick the right tool out of the toolbox. And I use options for their advantages, not for the sake of trying to be the smart guy, trying to outsmart Morgan Stanley or Goldman Sachs with an options arbitrage. I'm using options because of their mathematical advantages. Some people think options are a gamble, which they are absolutely positively are not. If you're an options buyer, your risk is limited to what you pay. Now, if you're on the wrong side of the market and you don't understand the probability and you don't put odds in your favor, yes, it is a gamble, and that's often where people get themselves in trouble. They buy cheap, out-of-the-money options. Here in Chicago, we call those lottery tickets. The guys at the exchange sell options every single month. So the June options expire here tomorrow, then the July options, and the August options. They sell options every month to the novice traders that are buying these out-of-the-money, low-probability plays that only have maybe a 5 or 10% chance of making money. So they sell those each and every month, collect that premium, and they have the best cars, they have the best houses, and live the best lives by selling that premium, by taking the odds, putting the odds on their side. So what I want to do is show you how to put the odds in your favor. You can control probability. I'm going to show you that little trick as well. Also, we want to extend the time frame because options are like ice cubes. They'll melt in your hands that last 30 days as we get closer and closer to expiration if there's not a significant movement in your direction. So what you want to do is you want to take the time component out of the equation. I'm going to show you how to do that. Buy more time than you need. Use time in your favor. Take time out of the equation. So I'm going to show you an example quickly here on XLF. XLF is the ETF that tracks the financial markets. This is an example of 50% return and shows that a modest move in an option, if you have the right option, can produce significant results. So you can see here back in October of 2014, this is an older example, XLF was trading at what, 23 or so, and over a period of time, it moved up to 25. Not a real big move, okay, but with the right option, it produced a 50% payoff. Let me show you the way that we approach this, and this is an example of how to harness the time properly. At the time, XLF was trading, like I said, around $23, and what attracted me to that particular sector is the banks still haven't recovered nearly, they're barely above the halfway point of their sell-off from 2007 to 2009. So they still have a lot more upside in the longer term as they recover. But looking at XLF, simply the stock substitution strategy, and a lot of my options friends kind of give me a hard time by being so simplistic with my approach, but keep it simple is the mantra here, is buying a deep in the money option, an option that's going to behave like the stock, has limited risk, and have plenty of time. So instead of tying up the money buying the shares, you can buy an option which controls 100 shares. In this example, the low was 1948 for the 52 weeks. So buying the 19 call gives you the right to be long from 19, and at that particular time, it costs about $425. So if you take that $425 premium, that's your maximum risk, add it to that $19 strike, that's $23.25. So the break even on this was about 50 cents higher. So again, very modest expectations, looking for XLF to move up 50 cents in a period. In this example, it was 1 year and 4 months. We were buying the January of 2016 options back in 2014. So we took time out of the equation. We bought a deep in the money call stock substitution strategy that's going to act like the stock. And as you saw, when it moved up, a very modest move, a $2 move, not even a 10% move in the underlying, the option went from 425 or 430 up to 6 and change. So that was a 50% move. Limited risk, plenty of time for good things to happen, and high probability. That's the combination of the stock substitution strategy. One of the strategies that I use when I'm looking for a stock to move up or down by a deep in the money call or put with my specific rules. So other people think options are risky. Obviously, we just showed you that your risk was limited to the premium that you paid, and oftentimes what I'll do is I'll put in a stop loss at half of what I pay. So if I buy an option for $500, I'll put a stop loss at $250, because mathematically, if the market moves the other way, or you're running out, either you're running out of time or the market's moving the other way, if you get to that halfway point. So from a risk control standpoint, I'm better off to salvage mathematically. Anything can happen. The market can turn around, obviously, but the idea is about controlling risk and living for another day for more opportunities. But still, the worst case scenario when you're an option buyer is your option expires worthless, and that's why we want to use that vehicle. Also, people think that options management takes too much time. Watching the markets, cheerleading your position, seeing a tick up or down does not help your position. What I want to do is institute a plan, have a discipline, know where I want to get in, know where I want to get out. I can check in on my trades on a daily basis, or more so on a weekly basis, because if I'm looking long term, looking to see what's happening, months out and weeks out, then I can live my life, do my things. My strategy changed when I had a daughter. Now I want to pick her up from school. I want to take her to dance. I want to take her to softball. I want to take her to soccer. I want to pick her up from school, drop her off at school. So I wanted to make the markets work for me, and options allow you to do that because they lengthen your time horizon and they allow you to ride through some ups and downs. So we've gone through the basics of options. I want to talk about two strategies here today. Actually, I just show you the stock substitution strategy to take advantage of a directional play in a stock. And the other strategy I want to show you is the cash secured put strategy. Now, it's a variation on the strategy from the previous speaker, and what this allows you to do is take advantage of probability. You are going to be like the floor trader. You're selling those lottery tickets. All right, so this is a way to generate consistent premium on a monthly basis. So now these June options are expiring here tomorrow. I'm looking to sell July options now and can't count on that time decay in the next 30 days. The idea here is to generate a 5% return in a month or less. All right, 5%. Now, I used to say that doesn't seem like a whole lot, but as interest rates continue to go down, and actually interest rates around the world, some of them are going negative. The German 10-year just went negative. 5% in a month is a huge return, but what you want to understand, it's a probability play, and these small monthly returns add up. If you annualize a 5% return over the course of the year, that's a big, big payoff. You do this in addition to your regular trades, and it takes advantage of the rule of 72. The rule of 72 is this: you take your annual return, and the average return in the S&P over the last 50 years, I guess, has been about 8%. Take that 8%, take 72 divided by that 8%, that'll tell you how long it takes your account to double. So it's going to take 9 years for your account to double if you're getting 8% a year. Imagine if you're getting a more significant regular monthly return as well. So this is an investment manager trick to build a portfolio. So the idea here is this is a way to get into stocks you want to get into at a lower price or get paid not to. So if you're an investment manager and you want to get into Apple, that's always a good example. If you want to get into Apple, you could put in a limit order. You say, listen, I want to buy Apple when it gets lower. I'm going to put in a price and wait for it. Wait for it. You have the money in your account. You're going to wait. You're going to wait. You're going to wait. But what this strategy allows you to do is allows you to get paid in the meantime. So let me show you here. If we go back to last fall when Apple had sold off a bit, it had that support. And you'd want to, if you're looking to buy it, let's say at near 100, let's say you want to buy it at 102, you want to lean on 100. What you can do is you can put in a limit order, say, listen, I want to buy Apple 100 shares when it gets to 102.5. That's $10,250. I've got the money in my account. Let it sit there, and wait and wait and wait until it comes down. Or what you could do is you could sell a cash secured put. You have the money in your account. This is not on margin. You have the money. You want the stock. Only stocks you want to own. So what you're doing is you're selling a 105 put. You're selling it for $2.50. So 105 minus 250 is 102.5. That would be your cost basis. That's where you would enter if the stock went down. Now, if it doesn't go down, you get to keep that 250. And then the June options go off the board, and then you do it again for July. And the July options go off the board, and then you do it again for August. You keep doing it until you get the stock put to you, and you're getting paid in the meantime. That's the strategy behind it. The key is only stocks you want to own. Now, Apple's not a great example because it's an expensive stock. So it's only stocks you want to own, stocks that you might be into for months, maybe even years. Now, the key here is to pick high volatility stocks that are typically low dollar. There are so many single-digit stocks now after the big sell-off that we saw in energy and mining and metals and commodities over the last year, where a lot of these stocks are down 70%, that you can sell a cash secured put as a way to get into it lower or get paid not to and take advantage of that time decay and that volatility and generate regular premiums. So here's an example. Here's in Sprint. It was a $5 stock, $5.60. You can sell the 550 put for 20 cents. You're getting a 4% return in a couple of weeks. The idea here is that it profits if the stock moves up, if the stock moves sideways, or even if the stock goes lower. The break even was 6% lower. So it has to go down more than 6% in a period of 30 days. You know your maximum risk is you'd be long the stock from 530, and actually at that time the low in that stock was 536. So you're buying at below the lows, worst case scenario. So it's a win-win situation. The stock actually moves up, so you get to keep the premium. You get a 4% return in just 3 weeks. So it's about probability and consistency. The idea here is to generate consistent monthly revenue on stocks that you'd want to own or get paid not to. And if you get put the stock, I'll show you that scenario in a moment as well. But again, the idea here is single-digit stocks. If you do it on a $10 stock, then you know what your downside is. You know, and again, it's not something you're doing on $100 or $150 stocks. It's the same principle as a covered call. It has the same risk profile as a covered call. It's just you're selling a cash secured put as a way to get into the stock first. Just like a covered call, you don't sell, you don't do it on the expensive stocks. If you do a covered call on a $60 stock and you take in $2, that $2 isn't going to do you any good if the stock goes down $25. So again, that's where the idea is to come in with the very reasonable lower price stocks, and there are so many of them now to take advantage of. So I could show you very quickly here in my service, my Bullseye Options service. There you go. We've got a number of plays going right now. Like I said, the June option expiration is tomorrow, so I tend to do a handful of these every single month. And so let me get into a trade alert. So I want to pick Twitter, and back in, let me just find my notes here. We did this in TRANSOCEAN on May 18th, did Twitter on May 12th. So let's go back to the Twitter play. Let's see here. There's Twitter. Okay, so May 12th. This is one of the trade recommendations that you'll see. It's a very detailed, comprehensive trade alert. So the new trade alert was on Twitter when Twitter was trading at about 14 and change. We sold the 14 put for June. It had formed a pretty solid bottom base with 14 as a support, and the premium on that was 80 cents. So that had put our cost basis at $13.20, so anything about $13.20 we're profitable, and Twitter right now is at $15, so barring something major tomorrow, it's going to go off the board and we're going to be able to keep that premium. And so it's a 6% return on risk in a period of 30 days. And we know our worst case scenario. Our worst case scenario is we'd be long Twitter from $13.20. So it's a 6% return, or buying the stock 6% lower. Again, a stock that we wanted to own. Another example here was in TRANSOCEAN. So on the 18th of May, TRANSOCEAN rig was trading at, where were we trading at there? About 10. We sold the $9 put. We sold that for 40 cents. So we took in, what do we have here? So I'm looking to see, it's a 5% return on risk in a month or buying the stock 13% lower. So it's a win-win situation, and you can see it had a 73% probability. So I'll get into the specifics of why the stock, why that strike, why that month, what the risk, where to get in, and so forth and so forth. So it's all about the math. It's all about the math, putting odds on your side. So a 73% chance, 73% probability it was going to be above that at expiration, and it looks so far. If we look at rig, where are we with rig right now? RIG, we sold a $9 put for 40 cents. It's at 10.39. So even though it's down 50 cents today, you know, the expiration is tomorrow. So I'll be looking to do this now for July, starting tomorrow and next week, that new series, and it's something we can do on a regular basis, monthly revenue. So what's most interesting is that this is the most successful when people are the most fearful and people are most scared and they don't know what to do. So if you go back to October of 2014, we had that big 10% sell-off. There's a whole bunch of opportunities here. Look at those returns on a monthly basis: 4%, 12%, 6%, 4%, 7%. And most importantly, to me, is the probability with 70% probability or greater. So if you go back to last fall, you could see the sell-off that we had, and we use that as an opportunity again. When people didn't know what to do, when people were most fearful, we use this, take advantage of the heightened volatility, sell the out-of-the-money put options, sell those lottery tickets on stocks we'd want to own at a lower level. So sell the $9 put in FCX, 13% lower, get paid 5%. Sun Edison, sell the 650 put, 17% lower, get paid 10%. US Steel, sell it, you know, 15% lower, get paid 5%. So that's the strategy on that. And let me even show you in US Steel, 15% lower. 15% in 1 month is a big, big move. So you look at it here, actually US Steel, that particular time frame did move 15% against us, all right? The stock moved 15% against us. That's a huge move. But guess what? Even with that big breakdown, we sold a 13 put for 60 cents. That puts our break even at 12.40. At expiration, the market was at 12.48, so it was above our break even. So even when the market went completely the other way, again, it profits not from where it goes, from where it doesn't go. If it didn't go below our break even, we're still profitable. But even if it was below our break even, the strategy, the other part of the option wheel, sell the put, get assigned the stock, then you could sell a covered call on it. Then you could sell a covered call. If you got the stock put to you at 12.40, then you could sell the next month's covered call, lower your basis again, that lowers your basis to 11.60. So you're long from 11.60, you keep selling covered calls until you get taken out. So the strategy here is only stocks you want to own, stocks that you can own for months, high volatility, lower price stocks. It's a probability revenue play. The strategy here, the option wheel, sell the put, get the stock, sell covered calls, repeat. Sell the put, get the stock, sell covered calls, repeat. So it's a win-win situation. So it's all about math. It's all about probability. It's something you can repeat on a consistent basis here each and every month, taking advantage of probability. So hopefully you'll get my message here is optimism, and it's about probability. I only want to be in positions that have a 70% probability or greater. And to do that, I'm going to use options, not stock. I'm going to be able to choose that probability. If I go back here, you know how I know what my probability is? My little trick here that I didn't spell out is to find the delta of the option. The delta here is the mathematical movement of the compared to the underlying. So if a stock moves up $1 and your delta is 75%, that means that your option will move 75 cents. It also, for our purposes, is also the probability that that option will be in the money at expiration. So that's where I choose the probability. I'm only choosing plays that have a 70% probability or greater when I'm putting on positions. So I'm using that delta as the key component in my decision-making process. I want to put odds on my side. So my service here is bullseye option. Let me just find. There we go. I was giving you a couple examples of the trade alerts. I do one or two trades a week. Again, it fits most people's lifestyles, not active trading. Here we took some profits at JP Morgan. Actually, this is an interesting trade in GLD. Got in on June 1st in GLD. Gold had been trading sideways, and then ended up taking profits last week before the big breakout made 50% in a week. 50% in a week from a money management standpoint, if you can make that kind of money, you know, and you leave some on the table, it's just something you have to live with. So that's a problem that I'm happy to deal with if customers are not happy with only making 50% in a week. But anyways, it's using options to take advantage of what the markets are doing, increase your probability, lower your risk, and increase your returns. That's the whole gist of the approach to the markets. So let me get that PowerPoint back on my screen. So I'll answer some questions here, but I wanted to mention Bullseye Options, Inner Circle membership. Oh, that's, I apologize. That's the advertisement. There we go. From CBOE TV, something I do every morning. That's part of my Inner Circle membership. You get 2 videos. You get a morning video from the CME group to kick off the trading day, and then you also get the pre-market pulse, which is what happened in the markets yesterday and what markets are on the move and what options are on the move. So you can get you know, a variety of information to keep you apprised of what's happening in the markets. Now, I'm looking big picture. I'm not worried about the minute by minute or the day by day, but it does build your knowledge base, and you'll get to see and learn from the interesting, unusual options activity and some of the market movers as well. But what I wanted to show here was you're going to go to 1 to 2 trade alerts a week. You're going to get a morning commentary. You're going to get those videos I just showed you, the CME and CBOE videos. $7 trial, bullseyeoption.com/TRY. It's a $97 a month service. Try it out for a month. See if you can have some fun, change your attitude, make some money, and have a new approach to attack the markets as well. So let me answer some questions as we go forward. Oh, the other slide that I want to show was someone who had made some money trading GDX. This was here earlier this year. We made some good money in GDX. What I wanted to illustrate is not the dollar amount, but the return that the options play on the options play, 50% return on the options play in less than a month. Obviously, they have a large account. That's why they made a large dollar amount. What I always, usually that's one of the first questions I get is, how many contracts to trade? I always start with 1 contract. Then you become a bigger, better trader. Initially, what you're doing is getting to understand the process. It's not important that you make or lose money. It's the process, and by using 1 contract, you're gonna keep yourself at very modest levels till you build that confidence. The markets are always going to be here. Then you become a 2-lot trader, a 5-lot trader, a 10-lot trader, or whatever it's going to be. More important than the number of contracts you trade is actually the allocation. What I want you to do, what I want to encourage you to do is divide your account into 20 slices of pie, so each trade is equal dollar value. So each trade would represent $500 or $1,000. So that would determine the number of options. It's not important the number of options you trade. It's the dollar amount that you have allocated. And the idea there is that if you divide your account into 20 slices of pie, each slice is 5%. So if you're completely wrong on 1 trade, you still have 95% of your account left. This is not gambling. This is not Texas Hold'em. This is all about probability. This is all about math. I've got good instincts and I've got pretty good opinions, but it's not about my opinions. It's about the math. And if the math's not there, I'm not doing the trade. I want probability on my side. That's what it comes down to. So let me answer a couple more questions here. So someone asked, what's the trading platform? The trading platform that I was using here in my examples was Trade Monster, which is now Options House. Started by options traders, for options traders, so it makes it easier. Thinkorswim is also another great place to go. Just make sure that your brokerage, understands options and that they give you the authorization to trade whatever strategies you want. Some brokerages will limit you to just buying puts or calls or whatever. But it's all about controlling risk, and for whatever reason, they don't necessarily encourage options. Some brokers don't encourage options trading, but you know, like I said, there are so many advantages. You can get such good risk control. If you're an options buyer, your risk is limited to what you pay. So let me move forward here and answer some of these questions. Can you show an example of the other 2,700 trades where you didn't make money and how you handled the market going against you? Oh, sure. You have a stop loss in place. Whole Foods had traded in a channel between 28 and 32, and it looked like it was going to break above 32. It didn't. It backed off and made new lows or very close to it and stopped us out. So we had an option that we bought for $500, got knocked out at 250. Now later on, the Whole Foods did come back, but the idea is to have the discipline, get stopped out, salvage what you can, and move on. The worst case scenario is if your option buyer is an option goes to zero. That's it. No matter what happens to a stock, I don't care how bad a stock gets, if you're an options buyer, zero. And I showed you the other example of a stock being put to you like in U.S. Steel. Now we've got a couple of positions that we're in on, that we're doing the wheel on. Chesapeake, we got that stock put to us in last December, and we've been selling options on it ever since. And now we had sold the June 450 call, and our basis is at $4. So if it's above 450 tomorrow, then we get it taken away. If not, then we sell the July option on it, continually lower our basis. Seadrill is another example of that. Let me just show you Seadrill. Seadrill. Seadrill's, we sold the $4 put using that option wheel strategy. Okay, sold the $4 put, took it a quarter, so our basis was 375. The stock went down, so we're long from 375. So we sold the July $4 call. Sold the July $4 call for a quarter, so that lowers our basis from 375 down to 350. So we're long from 350. Again, we know the downside is zero. So let's see, Seadrill, TRANSOCEAN, Twitter. Did I pass it? I think I passed it. So our cost basis is 350, and here we go, Seadrill adjustment, sell the covered call on it. All right. So I'm long 100 shares, which is, you know, for each option that we sold. So our cost basis is $350. Our cost basis is $350, so $350. Sold the covered call on the position to lower our cost basis. So we're long Seadrill from 350. Now, if it's below our $4 tomorrow at expiration, then we'll look to, I'm sorry, it's a July option. If it's below $4 at expiration of the July option, then we'll sell the August option. Continue to sell the calls against it to lower our cost basis until we get called out. So that's if the positions go against you. So there's a trading plan for each and every strategy. That's what's important. You know where you're going to get in, you know where you're going to get out. It's all about odds, it's all about risk reward, it's all about probability. It gets back to that methodology, having that plan. So give us a trial here at bullseyeoption.com/TRY. I've got a couple more questions to, a couple more minutes to answer questions here, so keep them coming, and I will be glad to do that. Let me go back to the question box here. And there we go. Someone asks, would out of the OAS work good? I can't read that. Is it OAS? Is that the underlying stock? For that, there are plenty of stocks if I go into that. So someone's asked what type of performance we've had with the service here. Of the closeout positions here in 2016, there's been 16 winners out of 18 trades. So things have been working relatively well. We still have a number of positions that are longer term. Most of our nearest term options are like September. When we're putting on new positions, we're looking, if we're buying options, we're putting on, we just did a January Microsoft position. When you sell puts, how many days do you look out? Typically about 30 days, 30 to 35 days, count on that time decay curve. Selling cash secured puts, again, you have the money in your account, you want to buy the stock. Cash covered put selling, I'm doing stock substitution right now. There are also earnings plays that we sometimes do, and earnings season doesn't start again until after the 4th of July. So with the markets where we are, we're going to take advantage with the tools that we have. As market conditions change, we've got plenty of other tools in the toolbox. Oasis Petro, I can take a look at it, but for me it's all about the chart and it's all about the map, and I'd have to look and see what the probability is if there's a play that you can look at. So let me just take a look here. So like I was looking at FCX, for example, for FCX is even bounced back today, so I guess we'll have to wait and see on that. But FCX, it's got that strong support down at the $9 level, so you could sell a July put. To give you that example here, you could sell a July put. The $9 put, you're not going to get enough premium. Typically, I want to make sure I'm getting at least 5% return on risk on a monthly basis to make it worth my while. But if we go out to the $10 put, the $10 put, you can take in, a nice little chunk of premium. So if you take in 50 cents, then your break even on that's $9.50. So $9.50 is more than $1 below where we are now, so more than 10% lower, and 50% return on $9.50, you're going to get that 5% return. So what's the probability on it? The probability, the delta on this is 31%. So there's a 31% chance it'll be at $10 at expiration. Now $9.50 is going to be probably about a 20-some% chance that it'll be there. So that means there's nearly a 75% chance that it's not going to be below that $9.50 at expiration. So if I look at this here, sell the cash secured put. Let's say I could get 50 cents. This market's moving around, obviously. And good till canceled. Let's analyze it in the trade lab and see what it has to say. There's a 67% probability that it's going to be above break even. So it's getting closer to that 70%. So we want to play with it a bit. But looking at it today, this is a stock that was on the move. It was down to 1060, I'm sorry, 1040 if I can remember correctly, and this option traded at 60 cents. So 60 cents would give us that probability that we're looking for. So that hopefully should answer some of the questions. Again, I want everybody to sign up, and at the, hang on one second, bullseyeoption.com/TRY. You also get a bi-weekly, every 2 weeks, an Ask Alan session where it's kind of like a group coaching sessions like I'll go through stocks for you, and we'll look at it. We'll look at the trades that we've been in, the trades that we're holding, and the trades we're looking to get in as far as trading candidates, and also talk strategy. So we do that on a bi-weekly basis. So I'll look forward to everybody who signs up. Actually, there's an event tonight to go over some of the option expiration for some of the June positions and some of the things we're looking at right now. The whole idea here is that I have demonstrated that I know how to put probability in my favor. And that's what we're looking to do here, is put odds on our side and use options to increase our probability, to increase our returns, and lower our overall risk. So one more question here, and then we'll move on and hand off to the next presenter. Let me see. Okay, I was going to look at OAS, but why does the put selling not work as well on larger price stocks? It does. It's all about the math, but if you get it put to you, it's going to tie up more money. 100 shares of an $80 stock is $8,000. So it's going to tie up a lot more money than in an $8 stock, 100 shares of an $8 stock. And again, it's all about rate of return. $8 stock ties up $800. So it's about having the ability to use these smaller stocks to be able to do a handful of these each and every month to generate some consistent returns and generate some nice premiums with high probability. That's the whole idea. Let me just go forward with this question, OAS, and see if it's a stock I'm not familiar with. And so the volatility is 70-some%. That's good. That means you're going to get a healthy amount of premium. I'd want to look at the chart. It's down 8% today. If you're prepared to own this stock, look at it. It's gone from whatever 4 to let's just say 10. So it's still up at the upper end of the range. Really, we've been trading between 8 and 11. Let's just say 8 and 12 here for a good period of time. So really 6 and 12. So 9 is kind of the halfway point. So what could you sell? using that same strategy, if you could sell, the options don't look that liquid. Look at the differential between the bid and the ask, 30 cents by 45 cents. If you could sell this option for 40 cents, sell the 9 put, then your basis would be 860. If you're prepared to be long from 860, then great. But let's look at it from a mathematical standpoint. Let's say you could get that 40 cents. What's the math behind it? The probability is only 63%, so it's not quite there yet. So it's something. I think you'd probably want to find a stock that has a tighter bid-ask spread on the options. The open interest on that strike is 645 contracts, so it's not zero, but it's not a ton. I think there might be better candidates just from a liquidity standpoint. I don't have that strong opinion on the underlying stock, and it's really not about the opinion on the stock. It's about the probability. And if you look at it, we've gone from 4 to 12. So $8 is really kind of the key pivot, and so the closer you could be assigned long, selling that $9 put for 40 cents, 860, I wouldn't have a problem with that. But you want to make sure that you're getting at least that 40 cents to do that. But you can see how 8 seems to be a pivot point. So selling that $9 put would be a way to get into the stock lower or get paid not to. So I appreciate your questions. Thank you very much for your attendance. I'm going to finish up here. Let me just go back to my PowerPoint. Get everybody to sign up. bullseyeoption.com/TRY. $7 trial membership for 30 days. You get my trade recommendations. You get my videos. You get my updates. You get my daily Where's My Head At video, something that's got my attention, maybe volatility, maybe unusual option activity. And let me just put in this chat box if I can. The address, so you can click on that, www.bullseyeoption.com/TRY. And so I want to make sure everybody can see that. Click on that, sign up, $7, 1 month of a $97 service, find out what it's all about, and hopefully change your attitude. There is always opportunity. People are losing their minds this week. There are so many ways to make money, in this cash secured put strategy is a way to get in stocks that you want at a lower level or get paid not to. A great time for that situation. I also showed you the stock substitution strategy, a way to choose directional plays but have enough time to be right, how to put the time component on your side. Also, the last thing I wanted to mention was I was talking about how people had bought calls when the market was at the bottom and still ended up losing money. And the reason they did lose money was because they bought the wrong options. So the idea here is that you want to buy the in-the-money calls. The in-the-money calls will profit if there's just a modest move in the underlying stock, and they'll have a significant profit. Whereas the out-of-the-money options, they'll die. They'll be gone. They'll and that's what happened. A lot of times, a lot of people bought too little time, and they bought those out-of-money options. So what you want to do is, like our Microsoft position here that we just entered into, the Microsoft position, the 45 call for September, was it 45 call for September or was it January? I don't remember. But anyways, the whole idea here is that it's deep in the money. So if it's deep in the money, the impact of time is very, very small. And so the time value component is the only component that's impacted by volatility. So what happened was, when the market came back, that volatility came out of the market, and the air came out of the balloons. Those options had become very, very inflated, and that air came out of those balloons. So even though they bought the right, they bought calls at the right time. And here's the 45 calls for September here. You can see the 45 calls right now are $5.20 in the money. So if they're trading at $5.60, there's only 40 cents of time value that's impacted by volatility. So even if the volatility decreases, it's not going to have that much of an impact on that particular option. That's why you want to buy the right option, the right strike, the right amount of month to put odds in your favor. So that's the lesson to be learned. Everybody sign up, bullseyeoption.com. That'll take you to this special offer, the $7 1-month offer. Like I said, it's a $97 a month product, and there's a $799 discount if you want to purchase an annual, which is buying a year's worth, and it's costing you 9 months of the service. So you get a discount there. But everybody sign up, bullseyeoption.com/TRY. I will be having my bi-weekly webinar, Ask Alan webinar here tonight. The Thursday nights is when I typically do it, and I want to do it before the expiration as well to update people on the positions that we have. And it looks like the rig position is going to work out great. The Twitter position is going to give us a 6% return in less than a month. The rig's going to give us a 5% return in less than a month. And the Chesapeake looks like we're still in the underlying stock, and then we'll be looking next week to sell the July option against it to lower our basis. We're above our break even. Our break even's at $4, but we just didn't get taken out with a $4.50. And Seadrill is a July covered call that we traded on that. So that's what we've got going. I appreciate your time.